welcome. We are pleased that you've joined us for today's session, Software and SaaS, Communications, Taxation Risks. And before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have a great group of speakers with us today, and their bios and contact information are located in your console for your convenience. And to get us started, I'm going to hand it off to Adam Cline, partner here at Moss Adams. Adam?
Thanks, Amy. Appreciate it. As Amy said, Adam Cline, partner in our state and local tax practice. Also presenting with me today is Tim Rutkowski, senior manager in our telecommunications consulting practice. And we have some guest speakers. Steve Lacoff, Vice President, General Manager of the Communications Tax Division within Avalara, and Toby Bargar, a Senior Tax Strategist at Avalara, who works within that Communications Tax group. So just a brief agenda here. We're going to kick off with Steve and Toby just giving a general overview of the ecosystem of communications taxation and some of the technology solutions that are out there. And then we'll get into a little more detailed discussion with myself and Tim leading that out, getting into some of the nuts and bolts of communications taxation and where we kind of unpack the federal, the state and local components that all meld together to form the basis of these issues. Over to you, Steve.
Great, thanks, Adam. Welcome, everyone. Thanks again for, as Adam said, for taking the time. I think the first thing that we want to talk about is just give a little bit of kind of background into the landscape here and what's driving some of the tax complexity with communication services, specifically as they relate to SaaS. Historically, telecommunications was a facilities-based business, meaning that voice, video, data were provided exclusively, over physical wires. But I think, as we all know, telecommunication services, so VoIP, video conferencing, wireless services, SMS, have not only migrated to the cloud where they're offered as hosted services, but now they're exposed principally through communication platform as a service companies as APIs, which makes them easily embedded into connected devices, apps, SaaS platforms, and a whole suite of services. And so, what that has really driven is a lot more tax complexity for, SaaS or technology companies that previously were only exposed and focused to sales and use tax. And so here, I think what we're illustrating is an example. If you start at the far left, you've got, CPaaS providers. Here's a couple of examples of prominent players in that space: Bandwidth.com, Twilio, Plevo, who are offering a whole suite and growing range of telecommunications services via API. And so what that allows SaaS companies and connected devices companies to do, is really embed those services within their platforms, monetize them, and unlock additional value for their customers, right? So, this innovation has been great from a business and customer value perspective. The downside here is that it's created, a lot of tax complexity. And so, when SaaS platforms begin offering communication services, as a feature, as a module, as they start monetizing those capabilities, what it does is opens up exposure to, a whole new regime of taxes. And so here on the right, we've got traditional sales and use tax, but then below that is this whole family and portfolio of various types of communications taxes that can be levied against those services. And we're going to go into more detail into what those taxes are and what they mean, and some of the specifics around the exposure. And again, here are just some examples of, the types of capabilities that are unlocked with SaaS services. These are typically like the primary use cases that we see, within our customers. The first is outbound marketing, right? So companies are leveraging telecommunication services at scale to connect with customers, to market their products from a net new perspective, or to drive upsell or attach with those products. Those typically center around voice and SMS. Obviously, contact center as a service is an exploding market. And so what we're starting to see is CRM companies offer contact center or IVR capabilities, as a bolt-on module to their core customer relationship management portfolio. The third here is notification and alerts. I think we're all familiar with getting updates, on our cell phones from rideshare services, from companies like Amazon, providing the status of existing orders and shipments. Again, those tend to be centered around voice and SMS. And then the last is IoT and connected devices. So here, these are capabilities that are tied into an IoT device. If you think about a security camera, right, where you're getting a text message to your phone indicating that, the camera has sensed something or an alert has gone off. And then the last piece here is data and wireless. We're starting to see more and more devices have wireless connectivity embedded within the device. And so there can also be tax implications around that. But these are just some of the core scenarios here. And then a key distinction here, as you're layering communication services, into a SaaS platform or an IoT device or an app, is the communication service material to your business, right? Now, unfortunately, this is a term of art. There's not a clear-cut rule here, and there needs to be a lot of deliberation and thought put into this. But what we've outlined here is a couple of basic examples. The first is a rideshare service, like Uber or Lyft, or a food delivery service, where they are leveraging communication services, just to provide a status update to the customer around when they're going to get picked up, how far their delivery is out, and driving customer notifications. These services are not monetized. They are not the true object of the service. And so, typically the use of communication services in that type of use case would not be subject to tax. Now, on the right, what we're trying to illustrate here is, a practice management software. So think about, a dental office, where frequently they sell a standalone module that allows the practice to drive outreach to the customer. And again, that could be updates on an appointment, that could be texting over a link to an invoice, that could be utilizing communication services to automatically outbound to customers to set up an appointment. But from the practice management software provider perspective, that is a bolt-on module that is sold, that is monetized, that has communication services as a core part of the offering. And so frequently, in those scenarios, communication taxes would apply to the SaaS platform that's providing the practice management capability. And so, these are just a couple of basic examples to kind of frame up when communication services may or may not be subject to tax on the invoice. The key point that I would make here is what we're really starting to see is as communication services are more easily embedded into a wide range of services, is communications taxes really start to proliferate into a lot of different segments. And so, what's been interesting for us is we have prospects and customers. If you visited their website, if you looked at their core offering, you wouldn't think they would be subject to communications taxes. But as you start to peel back the capabilities, you start to see that there is an exposure there. And so, we're going to get deeper into communications taxes and some of the complexity and the pitfalls here. But, if you are just embarking on this, this is intended just to provide a little bit of guidance on how you prepare for this. So the first is, and I'm sure this will resonate to a lot of people on the phone, is that tax experts should be involved early and often. Frequently what we find is companies are launching a new service, or there's an acquisition of a company and the tax team is brought in, in the tail end of that process. The one thing that we would stress is, a lot of involvement from tax experts, because there is going to be preparation needed, not only just from a core tax and compliance perspective, but it's going to impact automation, specifically the tax engine. And there are going to be implications on invoicing in terms of the correct presentment of that tax. The second piece here, monitor tax and regulatory changes across jurisdictions. I think what will become clear soon is that, we're talking about, thousands of jurisdictions here with multiples of that in terms of different rates and rules. And so, from this perspective, automation is really key to stay on top of that taxability and any of those changes from jurisdictions, as well as working, with advisors like Moss Adams early on as you're starting to offer new services to understand, what that taxability is and the exposure. The third point here is proceeding with caution with determining new tax liabilities. A key example here is just registrations, right? So it's really important to understand where you stand from a nexus and taxability perspective, and to really be thoughtful before you do raise your hand and register with the jurisdiction, indicating that you're subject to these taxes, because those processes can be hard to unwind. And the last piece is, a big part of what we're involved in is preparing your technology for specialized taxes. So many of these services are going to be subject to sales and use and communication taxes. It's important to understand that you've got a partner and a platform that can handle that multi-tax complexity and some of the interplay between those tax rules. The other point here is having a detailed breakout of taxes for engine compliance. What we're pointing out here is that for many communications taxes, an example of that would be voice. Some of those are going to be subject to things like the number of lines. That's that's an additional data element that needs to be provided to the tax engine to ensure that you're having proper calculations, and that you're not having to do work on the back end to allocate or break out those taxes. So it's more than just quantity and the amount that's sold. There may be other ancillary information that needs to be provided, and it's important to map that out. The last piece is granular reporting to power returns. It's important to make sure that you've got a really specific and consistent output from your tax engine that allows you to easily take those taxes and put them on the proper return. And it's going to make it simpler for you to work with your accounting partners to do that. So to make sure that you've got a granular breakout by jurisdiction, by tax type, as well as other data that you may need from a returns perspective. Because not only are we talking about complexity from a tax calculation perspective, there's a lot of complexity on the compliance side. All of those taxes that we outlined before typically have multiple forms that are associated with them. And then the last piece here is invoicing requirements. So there are statutory requirements in terms of how taxes need to be broken out and presented on invoices when you're selling telecommunication services. And so, it's really important to make sure that your technology platform can make that simple for you and provide you the breakout and the data that you need so that your literals on your invoice are compliant. And so with that, I'm going to transition this over to Toby, who's going to start talking about some of the critical success factors to think about if you embark on these projects.
Yeah, thank you, Steve. So yeah, I want to touch a little bit on if you are going to implement one of those automation solutions like Steve was just describing, some of the things to kind of keep in mind to make sure that goes well. And probably the most important factor of all, I would say, is making sure that all of your products get categorized properly when you do that, right? And that whatever system that you would choose for that has categories for the things that you're selling, right? So if you've been selling software, SaaS services, obviously you want to make sure there's content for that as well. But making sure that you have content for, if you're including a voice over IP function or a SMS or information service or any of these other sort of additional items, that there's categories for all of that, right? One of the most frequent things to go wrong with the overall tax automation process is, calling the apples oranges and the oranges apples, and has predictable results. You don't typically get tax out the other side correctly. Another important thing is if you do have bundles, making sure that you approach those correctly. And I think that Adam's going to spend some time kind of breaking down some more detail on how to approach that. But oftentimes in a lot of these sort of scenarios, and if you look at some of the examples that Steve went through earlier, these are offerings that typically are going to involve some combination of maybe software, maybe some data storage and some other things in addition to the voice services. And there's some definite implications there and some good approaches to what you need to kind of look at to make sure that you tax the entirety of that bundle correctly. Making sure that you get the right words on the bill, with the taxes is pretty crucial, as Steve mentioned. To expand on that a little bit, some of the jurisdictions require that their taxes, in particular on some of the communications taxes, have to have specific language used on the bill. You need to say, you might want to have a generic 911 fee, but if you sell something in San Leandro, California, you need to present San Leandro emergency management fee right on the bill. And if you don't use those words, you've potentially gotten yourself in trouble with the city. And there's also issues that sometimes people are tempted to want to try and combine a lot of this, because potentially, as I'm going to talk about here in a minute, you might be getting quite a few lines of tax back when you sell some of these services, right? In addition to the sales tax, there can be 3, 4, 5, 6 other taxes potentially that come back with that. And so there's a temptation to sort of streamline that and make it look as minimal as possible. But there are some rules that some things can be combined with other things. You have to be careful about the headers and descriptions that are used for certain taxes, and so you got to have some awareness of that, or work with somebody who's got some awareness on that. And then obviously making sure that you get all of the data out of the system to support your audit, to support your invoicing and your reporting. Can you tie back the lines of tax coming out of the tax system to the individual line items on the invoice? That can tend to be a pretty crucial step to being able to pass a lot of audits, is being able to trace all that back. And so a good test when you're evaluating these sort of systems is, what does that look like? What does it look like if I need to trace the reported revenue back to the bill? And then obviously making sure that you're working with a company that can take care of you and provide you good support. And in particular, data updates and patches and all of the data and content that has to be provided to make sure that one of these tax systems works correctly. Are you having to install that patch, or is the vendor going to do that sort of thing for you? So important thing to look at. I want to turn a little bit and talk about pardon me, I want to talk about some of the things that make communications tax hard. And you may have heard, actually, I think I got a slide too far there. Sorry, guys. Nope, never mind. So you may have heard that communications tax is hard, right? It's one of the first things people oftentimes tell you if you wind up into the communication space. People will say, it's a little bit more difficult than a lot of stuff, and I would agree, right? Communications tax, I would kind of die on the hill of defending the concept that, especially in the U.S. telecommunications taxes is maybe the most complicated indirect tax scenarios that there are. And some of the reasons for that I would use to back up that system, or that statement. Firstly, the fact that you are dealing with multiple taxes applied to the same service adds significant degree of difficulty, right? So you are likely still subject to sales tax on a lot of these items in a lot of states, but then also potentially special communications taxes and regulatory fees and various economic activity taxes that apply to phone companies. And so you've got a long list of items that you're complying with. A follow-on to that adds kind of to the difficulty is that there's a pretty wide application of how those apply to the different items on your bill. Going back to the fact that, okay, you're going to add a voice component maybe into your product. Are you going to have different types of voice usage? Or there going to be features, different types of features? All of these sort of subcomponents or sublines of info that can either be invoiced directly or packaged into a bundle, all potentially have sort of a slightly different outcome of where they are in the Venn diagram of which taxes apply to them, right? So it's unfortunately not just a universal thing of communications services are subject to this in this particular state, right? It's kind of a widely variable thing, and so some parts of your bill will be subject to some things and other parts to others. Another kind of wrinkle is that we have frequently in this space different outcomes for different types of buyers and sellers, right? So depending on where you are in the country, you might have different rates for, say, B2B sales versus a B2C sale. Residential buyers oftentimes will have reduced rates or different tax applications to them than a business, and different types of sellers. So within the communications space, there's a wide variety of different types of classifications that you could be plopped into for regulatory purposes and filing purposes and that sort of thing. And in a lot of jurisdictions, where you as a seller fall into that platform can drive you to different results and outcomes. And then citusing is another tricky thing. If you guys have been selling software, hardware, services, you're probably familiar with the kind of general ship to, bill to, ship from type of concepts for citusing tax purposes. With communications services, it's a lot messier. There's many different citusing principles that can come into play depending upon the type of communication service. So there's different sorts of rules that apply for traditional network phone services versus wireless. There's a federal regime that kind of dictates how wireless services are to be sourced, and people do kind of different things for voice over IP. And so that can drive to some different locations that you'd wind up getting tax back on these services. And then another thing to keep in mind is that there can be some really complicated math on this. If you've been dealing with sales tax compliance, you may be used to a world where you can get kind of your hands on a sales tax table and just plug it into a system and do sale price times the tax rate and come back with a result. Unfortunately, with the communication services, that generally won't work. And some examples of the math problems that come up is that we have a lot of taxes in this space where there are either thresholds or caps or tiers on the amount of tax that can be collected, or they're on different increments. We have per line taxes. We have invoice or fixed amount taxes that apply in this space. There's a few places that we still have per minute taxes here in the U.S. So there's some other things that go into calculation that can be a little thorny. And then probably one of the biggest things that really messes up that math is we have a concept here in the comm space of either tax on tax or tax on fee, where many of these things, as I described, you might get this bill that has 4, 5, 6 items on it. It's not uncommon that several of those items will need to tax the other items, right? So if you have a combination of things that are fees or surcharges, you may have to have, sales tax, or some of the true fiduciary end user taxes are going to need to tax those, and vice versa. And sometimes we have some items that need to tax themselves. Sometimes we have some items that need to tax themselves repetitively. And then, as we already kind of touched upon, you have some sticky rules about how you have to present things. And then kind of the final note I'd have there about the complexity is that there can be some really messy naming out there, right? So for an example on that, we have many hundreds of tax types now within our communications tax platform that we use in the communication space. And it, the fortunate, unfortunate part of it is that I could really kind of distill most of those down to about a dozen to a dozen and a half primary categories of what those taxes are from a policy perspective, and how they fit. But there are these, sort of proper names, and different jurisdictions come up with completely different ways of describing what's basically the same item, and unfortunately that can make it a little tricky to keep track of what's what, just because of the fact that you got two states that are calling what's basically the same thing by completely different names. So what are kind of a high level of view of the sort of taxes that we're talking about? What does that look like? Fall into, as I said, kind of two main sort of important categories to divide things through in your head. And the first one is a group of taxes that apply to the seller, right? It's one thing that a lot of people don't realize, but if you look, for example, down at your cell phone bill, probably close to half the items that are down there below that tax and fee and surcharge line item are actually things that the phone company or the communications company is passing on to you as a surcharge. So, their obligation. And so some examples of some of the things that frequently fall into that category, that wind up down there and you have to account for. Universal service programs. This is a group of regulatory programs that are designed to help provide access to communication service around the country, make sure that we build out infrastructure in places that are not economic, and provide phone services to schools and libraries and health clinics and a variety of other programs. There's a program called the Telecom Relay program that's providing phone, special communication services for folks that have like a speech or a hearing impairment that would prevent them from being able to use normal communication services. And that obviously has a budget and needs to be funded, and that's usually going to come in the form of a surcharge passed on to the customer. Lifeline, program. So the Lifeline program is a program to provide subsidy credits for folks that have below a certain economic threshold and qualify for public assistance in order to ensure that they're able to purchase phone connectivity. And obviously that program has a budget, and there's state versions of those as well that have budgets and have to be funded through surcharges. Various regulatory agencies, whether it's the FCC at the federal level or state regulatory agencies, will have fees. Economic activity taxes like gross receipts taxes, privilege taxes, business and occupation taxes. These are all basically alternatives to income tax that are collected on receipts from these communication services and frequently get passed on to the end user. And then you have local regulatory charges, right-of-way, franchising, et cetera. On the taxes applied to the buyer, there's probably some things you might be a little bit more familiar with. So sales tax. There's some excise taxes that apply to communication services, both at the federal level and at the state level. Utility taxes or utility users taxes or communication services taxes. There's kind of a variance of different names here, but these are specific end user taxes that the state or local jurisdictions have passed to impose upon communication services. And then obviously you have in interconnected line-based services, you might have to be responsible for 911, poison control, suicide prevention, some of these other programs that also are funded through these fees. From a direction after that, I would point out that the next sort of level to that complexity, I just listed off a lot of different types of tax. The thing to keep in mind is that you wind up then having to also obviously remit all of that, right? And this is one of the other things that makes communications tax compliance particularly difficult is that you're dealing with, double or triple or more of the sort of remittances that a sales tax filer would typically deal with, right? So you've got sales and use tax, but you've also potentially got, these state and local communications taxes and various economic activity taxes, communication services taxes, 911. You may be dealing with some agencies you wouldn't normally have had to deal with, right? So in addition to a state Department of Revenue, you might have a state regulatory agency that you're going to have to file some items with. You might have to file with the FCC. If you're subject to 911 compliance, you're likely going to have to file with potentially like local sheriff's offices or 911 authorities and some other folks. So it's going to add enormously to the overall footprint of what you're looking at from a returns and a compliance perspective. And with that, I think we are going to move on to the technical discussion. Oh, Adam, I think you're muted.
No, we can't, Adam. Well, while Adam tries to connect, I'll try to fill in as best as I can, though I'll say I am not a sales and local tax expert such as him. But we can loop back to some of these, but some of the specific items that we would like to cover being federal excise tax, thinking about looking at those regulatory fees. So the FCC, which has its own unique set, as well as individual state public utility commissions, the state and local tax, and then the mitigation steps that we can take there on those. So moving into the federal excise tax. So the federal excise tax is imposed at a 3% gross receipts on local telecommunications revenues. It comes, I believe, from the Spanish-American War. So it's been around for quite a long time and has just never gone away. Thing to keep in mind there is it's again on local telecommunications service. Anything related to the bundling of long distance or toll services that would extend beyond the local calling area, federal excise tax does not apply. It is a transactional tax that's ultimately passed on to the customer and remitted to the IRS. There has been a significant amount of litigation to limit the application of federal excise tax to just telecommunications services, again, unless those services are charged based on time and distance, otherwise known as long distance services.
Hey, Tim, can you hear me now?
Yes, great.
Okay, great. And I appreciate the irony of not having connectivity in a telecom based presentations. Not lost on me. Thanks for picking that up while I was logging out and logging back in. But it seems like you covered the FET slide, so I'll go ahead and advance it. And it looks like it's still you there, Tim, for kind of regulatory compliance, FUSF, USAC world.
Yep, absolutely. So I'll keep going. So from I know we kind of touched on the high level, but I do want to provide some kind of frame of reference for the magnitude and scale that some of these assessments could be, because they are fairly significant, especially when we look at the Federal Universal Service Fund. Federal Universal Service Fund is the contributions to promote FCC programs, so Lifeline, Universal Service Connectivity that Toby went over. That assessment based upon interstate revenues, and again, how we get into those jurisdictional buckets, we'll get into the allocation methodologies. But if you look at that, 29.2% is a significant contribution amount. Layering on those and others, and so that's filed via the FCC Form 499, which is just a reporting mechanism that telecommunications providers have to file, one of many compliance forms, but which also drives the other federal assessments, whether it be NAMPA, which is North American Numbering Plan, of which all these are pretty minimal in terms of total number compared to the FUSF states. But we have the TRS, local number portability, and the FCC regulatory fee. Then you get to the state side, which again, this can be fairly variable. Some states have their own unique state universal service funds that provide subsidies to high cost areas, as well as Lifeline and other sort of public works programs. Just like that, state telecommunication relay services, 911 fees. Here's where most cases those are on a fixed per line or per connection type basis. And here those remittances can be either to a singular source across the state, or you may have to deal with each individual county. And if you provide across, say, a state of Texas or there could be a significant amount of returns, the multiples as you provide services out throughout a specific area. 988 surcharges, which are fairly new. There's not too many states that have those, but they're becoming more and more prevalent. Public utility fees, as well as a host of other miscellaneous fees that may be assessed depending on the state or locality. And so in becoming a telecommunication provider or stepping into that space, not just having a business license states, but there's specific telecommunications registrations that likely will have to occur. From a federal level, that's generally with the FCC. You obtain a federal registration number, as well as obtaining FCC Form 499 filer ID. 499 it accomplishes a number of things, as well as registrations, contact information, but it really is the basis for the contribution calculations to all those various federal funds that I outlined. It also provides some of the guidance and rules for the allocations of the various revenue streams that you may have. Within each state, it can vary wildly based on what may or may not need to be done. Some do require some level of just informational filing that we are a telecommunications provider, a VoIP provider in this state, and that just provides company contacts. There are other states where you do need to obtain a certificate of public convenience and necessity, which is just a formal registration process and filing of what we'll be providing, where you'll be providing it, and so forth. Even to the other extreme of some states require nothing from specialized from a telecommunications perspective. What matters when we're trying to identify our telecommunication revenues, and which drive into the registrations, are what are we actually providing? So that telecom versus that information, software, or equipment revenues. And we kind of touched on this briefly before, but the bundling or separately provisioned of the services, is it a bolt-on or is it just a full integrated service together? Are there standalone offerings for any of those particular services? Do you offer? How are your contracts or agreements structured? Is this spelled out specifically where there's that communications component to it? What it is including, what it doesn't include, as well as then how that all ties into your invoice. Ultimately, a regulator would look at how are you charging this to a customer, because if it's all together, that can impact the presentation invoice just as much as the kind of thoughtfulness and strategy of how we package our services together. Flowing that through the invoice can be just as important. And so when looking at this, from an FCC perspective, and states generally speaking will abide by this, when we're looking at telecommunication service and in specific, say, VoIP services, which probably is the most common type of service that would kind of encroach upon this area, being VoIP, interconnected VoIP. The FCC provides two specific kind of methodologies to allocate that bundle of revenues between the interstate jurisdiction and intrastate jurisdiction, each of which would be potentially subject to its own set of fees and assessments. 64.9% being interstate is the safe harbor that should you elect to follow that as an interconnected VoIP provider, there is no real documentation or support necessary. It's simple, it's consistent. It has not changed in the course of my career, and I believe since its inception, and likely and unlikely to change from that perspective. So that's one route that certainly companies starting out follow. The second is a traffic study. So really looking at and analyzing the actual calling patterns and call records and minutes of use that your customers are using. And so using that, you can allocate those revenues based on those relative percentages. It does need to be, specific in terms of encapsulating all customers, all calling to and from numbers, and would be updated, based upon how often the company would like to do so, either quarterly or on an annual basis, and really documenting the process for that. Obviously, it's like a chicken or egg. You have to have traffic first to develop a study. So again, most companies start with a safe harbor. Once sufficient traffic is generated, then moving and looking at traffic study, because generally it does end up falling less than that 64.9%, but you do have the burden of substantiating that upon an audit or review. And so in terms of filings and cadences, they can be monthly, quarterly, or annually. They kind of vary, especially from a federal or a state perspective. Toby touched on, you can have many different administrative and collecting entities. It's not just one, you're not just working with the FCC or working with the State Department of Revenue. You can have multiple different entities collecting this, which just exacerbates the amount of forms that you have to. And as well as following the forms and their specific reporting methodologies. It's not necessarily as simple as just we collected X number of dollars in State Universal Service Fund revenue, but rather going through the steps of how your revenues got allocated from total revenue to telecom to then what is determined to be intrastate, and vice versa for the FCC and 499 reporting.
Okay, and I guess, Tim, can you hear me?
Yes.
Okay, check. Make sure I didn't have that problem twice. So let's transition back to me. As you can probably pick up, there's a lot of rules that come in at the federal level to determine what is a telecommunication service versus what is an information service, with telecom being those types of revenues that contribute into the Federal Universal Service Fund, as well as other items like VoIP that are more discretionary on the part of the FCC for contributing into the Federal Universal Service Fund, versus information services that do not contribute into the Federal Universal Service Fund, all the while keeping in mind that doing that determination at the FCC level is really only for the FCC. That does not set the stage for what the state and local tax ramifications may be. There are some areas of federal preemption, but there is not a direct translation into what's a telecom service begets, whether it's telecom service for state and local purposes, with just kind of a backdrop that there are more instances where services are telecom for state and local tax purposes than there are for federal. So current environment, why should you care? Well, I think at a starting point, if you're a SaaS company, assuming you have Nexus in every state of the union, you're going to deal with an average tax rate of just around 8% or a little under. And you're really only going to deal with that in about half the states, because certainly not all states tax SaaS. Well, in the telecom world, as you can see, the rates are a lot higher and they stack. As Toby was getting at, there's lots of different taxes that can apply at the same time, simultaneously, as well as having tax on tax tax. So the output of contributing into the Federal Universal Service Fund is passing that charge on to the customer in the form of what's called the FUSI, or Federal Universal Service Charge. That charge is not a tax, even though it's passed on. It looks like a tax, it sort of smells like a tax, but legally it's technically not a tax. So it's a gross up of that telecommunication service, and then you can have sales tax on the FUSI. So you can be grossing up your selling price of VoIP or private communication services, whatever the case may be, by that amount. And that's really where it makes these issues a lot more prolific, if applicable. In addition, while slightly less than half the states impose sales tax on SaaS, almost all the states, with some exceptions, Idaho, Nevada, if I remember correctly, do not impose sales tax on telecommunication services, but most do. In some states that are the nomad states, New Hampshire, Oregon, Montana, Alaska, Delaware, that don't have a sales tax, have other transaction taxes that can apply. Montana has a telecommunications excise tax. Oregon cities have these telecommunications privilege taxes that can apply. And so you have those sort of issues that can come out of the woodwork. So that's kind of the big question of why would I care? Wouldn't this all work out the same? The answer is no, because you have more jurisdictions and you have many more taxes with tax on tax effects that can apply. This is just a variation here on the differing definitions of what is a telecommunication service. There's variations on them. And as you can see at the bottom, there's the FCC definition, which is not the same as the state definitions. The top two definitions there, the Streamlined Sales and Use Tax Agreement state definition, which is slightly less than half the country adopts that. And then the non-SSUTA definitions, there's an example there for Texas. They're all slightly different, all the while none of them being statically consistent with the FCC, which is where some of these problems start to dovetail. And again, there's no federal law that explicitly says that once you have a determination at the FCC level, you shall have that same determination at the state level. There's just nothing that really says that. Information services. This is a unique area within the telecom realm. Information services are a term of art at the federal level. An information service is not a telecommunication service. It's an exception. It's a service that's where the value or the primary purpose is not merely the point of transmission or more to the point, the pipe. If you kind of think about a pipe with water flowing through it as an analogy, if the true value or primary object of what the customer's after is the water or the information that's traveling through, probably more likely an information service. If the true object is the transmission, just merely to have point-to-point communication, whether it be text messaging, voice, what have you, probably more likely telecommunication services. All the while keeping in mind that within the sales tax world, information services do have a place in terms of the selling of data, but that is an entirely different delineation for sales tax purposes than an information service for this purpose. This is an exception to a telecom service, whether it's an information service for other purposes, like in New York, New Jersey, Texas, Ohio, that impose sales tax on electronically transferred data. That's an entirely different distinguishable issue. So just something important to keep in mind as you're navigating these things. And keeping in mind again that information services are often an exception at the state and local tax level as well for telecom. But that in a vacuum doesn't mean you're out of the woods. You may still have, even if you can demonstrate that something's not a telecom service, it's an information service. If the true object is access to pre-written computer software, it may remain SaaS. And if in a state that taxes SaaS, it may be subject to sales tax. The FCC has issued a number of rulings on taking the position at the FCC level for purposes of contribution into the Federal Universal Service Fund, whether certain activities are information services and therefore not contributing, or they are telecommunication services and therefore contributing and subject to payment and passing that fussy on to the customer, so on and so forth. The states are all over the place on the concept of text message services in terms of whether those are subject to tax as a telecommunication service or not. Again, their SALT and FCC are not congruent. So as you can see here, there's a capture of about 7 states, Texas through New York, that view the provision of text messaging services as being more of a consuming telecommunication services to provide software as a service if you have like an app enabled text messaging service, whereas these other states, Indiana, Missouri, North Carolina, Virginia, in the form of instant messaging, view that as not consuming telecommunication service to provide SaaS, but rather consuming SaaS to provide telecommunication services, which can have ramifications on the retail sale with the customer as to whether you need to be charging sales tax, utility tax, contributing to different other funds and surcharges and what have you. And are you purchasing perhaps for resale telecommunication services that you might be buying from an upstream vendor if your end sale to the end consumer is a telecommunication service? You got to have parity on both sides of the equation there in order to establish purchase for resale positions as a general matter. Another popular FCC ruling that's come out in recent years is what's been referred to as the WebEx ruling, which is kind of sort of similar to the platform we're looking at here, more akin to Zoom and what have you. But the concept of providing an integrated software as a service type of platform that allows for the facilitation of group calling, calling using the call-in numbers, sharing content on slides and what have you, and whether that, in whole as an integrated service or in clipping off different pieces of it is a telecommunications service or an information service. And at the FCC level, that's generally viewed as an information service and not contributing into Federal Universal Service Fund. Although technology can change a lot, and that's not to say that type of service is forever an information service by any means. But as you look across the states, they're all over the place again, just like in text messaging services. And I think the biggest takeaway here, you can see, Arkansas, New Jersey, Tennessee, where they're coming out. Are they an ancillary service that's subject to sales tax, an ancillary service? As an ancillary, by the way, is basically an add-on service that's sold in conjunction with a telecommunications service. And sometimes ancillary services are subject to sales tax, sometimes they're not. It just depends on the jurisdiction. There's another capture of a few additional states, Kansas, Mass, and Illinois, again, demonstrating the variety here of, where these things, can land. And by the way, a lot of the published guidance that's out there on these issues is really just for sales tax. There's some published guidance out there on utility tax and other fee and surcharges as well, but sales tax is definitely the most prolific tax at the state and local level of having published guidance. But keep in mind that just because something is a telecommunications service for sales tax purposes does not in a vacuum mean that the offering is a telecommunications service for utility tax purposes, or vice versa, because they're technically different tax codes with different definitions, and you can reach different outcomes. We have to talk about the internet because that's always a big part of the equation. And there's always the question of if I provide access to the internet, is that taxable? Or if I provide services over the internet, is that taxable? What does that look like? This is an area where federal preemption can play a pretty big role. And that is, the Internet Tax Freedom Act. It's been around since the late 90s. It's gone through many, many changes. In its most simplest sense, what it does is it has two components. One, the preemption of what are called discriminatory taxes on electronic commerce, as well as the preemption of tax on internet access services. Internet access is generally the provision of access to the World Wide Web, where it's not access to a specific site or just pipe, but access to get out to access the World Wide Web and access video clips, content, go to your email, what have you. Email, by the way, is also considered to be internet access. And that is preempted as being not subject to tax. And not subject to tax means transaction taxes. So sales taxes, utility taxes, those types of taxes that would generally be viewed as being passed on to the consumer or possibly imposable on the seller, but contractually passed on to the consumer. There are some exceptions. The Texas franchise tax, the Ohio commercial activities tax, the Washington B&O tax are all specifically called out, not by those names per se, because that's not the way it ever works in the law. You never actually name the jurisdiction. You just describe something that mirrors that jurisdiction, so it can only really be that jurisdiction. But those taxes are accepted. The B&O tax, the Ohio CAT, Texas franchise tax can all apply. Those are accepted, as can income taxes, taxes on capital, net worth, and property taxes. Those are all applicable as well. But that leaves with is any other tax that would be imposable on internet access services is therefore preempted and not imposable. There used to be a concept called grandfathering, where there's certain states that impose sales tax or transaction taxes on internet access prior to the enactment of ITFA were able to grandfather and carry on that taxation. That'll expire effective June 30, 2020. So July 1, 2020, grandfathering went away, and at the end of the day, all states and localities are just preempted unless you're specifically accepted, like Texas franchise tax, Ohio CAT, Washington B&O. I threw in the Oregon CAT, the corporate activities tax there, is because there's a question of The Oregon cap is not specifically called out as being specifically accepted under ITFA. So is it subject to the, can it be imposed on internet access? I think there's a big question on that. You keep in mind that services that ride over the internet, like VoIP or Netflix and what have you, that's distinguishable. That's not provision of internet access. That's a service that you use internet to provide or service. Those are not preempted. That doesn't in a vacuum mean that they're taxable. It just means that ITFA does not preempt the taxation thereof. Discriminatory taxes on electronic commerce, that's an area that we're starting to see kind of renewed publication of in the news and what have you, because anytime you have a tax that, and this is ITFA preempted, anytime you have a tax that's imposed on a transaction that in a non-electronic analog would not be taxable, then there's the specter of whether the taxation of it by nature of it being transferred electronically is discriminatory. And ITFA stands for the proposition that if you're taxing certain transactions merely because they're transferred electronically, that's theoretically discriminatory and impermissible, therefore preempted under federal law. Bundling, Toby hinted at that. It's really a concept where you charge for a single non-itemized price, but you have multiple different items in your basket. The issue becomes, how do you tax that when you have separate tax character distinguished transactions in there? And that can be all over the board in terms of how that plays out. There can be telecommunications specific bundling rules where you, even though you might have a single non-itemized charge, you may be able to break out what the tax effects are of the taxable transactions through books and records. Those states, slightly less than half, that follow the streamlined sales and use tax agreement have a separate rule called bundled transactions that can apply in certain aspects. There's something called the true object test that we use in the state and local tax world to determine what did the customer subjectively intend to purchase in terms of what they were buying, and can there be a breakout? There's a mention of the accounting rule under ITFA that's a special rule that applies when you have internet access, of following that books and records rule, that if you can separately demonstrate through books and records that portion of the charge that the value is internet access, then that escapes taxation under that. But there's kind of a nebulous books and records and rule that isn't always super clear about exactly what that means and where it stands the test of time under state tax audits. But when in doubt, itemize, have separate charges for each. That's generally the best way to combat bundling issues or bundling risks. Sourcing. So sourcing, determining where transactions are sourced by jurisdiction. There's a litany of rules that can apply. It's not always just merely the customer billing address. And in some realms in the modern economy, customer billing address can sometimes be hard to grasp, especially if you process payment through certain platforms where you're not capturing a lot of data about the customer identification and what their billing criteria is. That again, in the telecom world, billing address may be coincidentally a place in which you source in a lot of circumstances. But you can have a lot of other outcomes too. Some states only apply sales tax to intrastate charges, meaning a telecommunication service that originates and terminates within the state, versus interstate charges. There was a U.S. Supreme Court case that came out a number of years ago called Goldberg versus Sweet that set the stage for, if you want to impose tax on an interstate charge in order to have it sourced to a state and be imposable, you have to meet what's called the 2 out of 3 test. The telecommunication service had to have originated or terminated in the state and be billed to a service address in the state. So you'll see that nomenclature find its way into the sourcing rules and in quite a few instances. Also have the Mobile Telecommunications Sourcing Act that generally applies to mobile services, but we see that those nuances of sourcing to what's called the primary place of use of the customer, as demonstrated by billing address, gets replicated in a lot of other sales tax sourcing and utility tax sourcing issues as well. And then you can have oddball issues like private telecommunication service can get sourced or broken up by the nodes or channels that guide where the service is being utilized and terminating or originating, as the case may be. Identification and risk mitigation. Generally, do a nexus study, determine what your taxability is, determine what the character of your revenues are, be looking at, do I have risks? If there's ambiguity in terms of where the risks could be seeking advice from tax professionals. Where things are really ambiguous and gray, be possibly looking at entertaining getting private letter rulings from the jurisdictions to demonstrate where at least you're getting their opinion of where you may be subject to different taxes, fees, or surcharges, and also determining where your exposure analysis is. You don't want to be getting caught with these issues when you're going through a transaction, a SPAC, an IPO, getting purchased, admitting to investor, having these different inflections for having diligence come up, and then you're kind of at the whim of that those other parties, and kind of work through the issue there in arrears. That's a pretty tough spot to be in. There's ways to clean things up, voluntary disclosure and what have you, but getting after these things as early as possible definitely helps. And getting the line of sight on tax automation, tax engine implementation, a lot of things that Steve and Toby were talking about on the front end of the call. You want to be thinking about these things if you have these risks now, in terms of the horizon to get them implemented and how to clean up the past, to comply, have the liabilities sit where they should sit at the customer level, and be limiting the risk of the company if you have the specter of these issues. So I think we're at time. I'll turn it over to Amy. I see there's a couple questions in the chat, but we can follow up with you post session on those.
All right, thank you. So yes, unfortunately we are out of time, but thank you all for your presentation today. And for those of you that submitted a question, we will do our best to follow up with you, as Adam mentioned. And if you have further questions or comments, please reach out to us, and we'd be happy to continue this conversation. You can drop a note in the Q&A window or reach out to any of our presenters directly. Their contact information is in your console. And finally, here's a link to a survey for today's webcast. And thank you for joining us. Take care, everyone.
Thanks, guys.